If your taxable income for this year is under $83,350, you pay 0% on long-term capital gains. So a quick side tip for everyone, if you know your income's under there, you can actually realize some long-term capital gains on purpose. It's called tax gain harvesting and pay $0 in federal income taxes as long as you're not exceeding that $83,350. Be mindful of state taxes, but at the federal level, you'd be in the 0% bracket. So what this is doing here, this extra in our example, $100,000, this is going to be taxed on this rate, which means you're going to get some at the 0% rate. So the amount between $74,000 and $83,350, that's taxed at 0, and then the amounts above that is taxed at 15. So the good news for a lot of investors, when they're worried about we're selling a property or we're selling stocks, we're selling a business, yes, you're going to be taxed, but it's not actually driving your ordinary income rates any higher. That's completely going to be on the capital gains side. Now, one thing to note is in addition to federal capital gains, you have to be mindful, of course, of state capital gains. Some states tax capital gains differently. Some states treat capital gains just like ordinary income. California, where I live, that's how they treat it. There's no difference between capital gains and ordinary income. They're all taxed at the same rate. On top of that, you have what's called net investment income tax. So this is called the Obamacare surcharge. 3.8% extra tax if you're exceeding $250,000 of adjusted gross income. That extra 3.8% tax will be added on top of this. So those are just a couple of side points, but when you're looking at the federal tax brackets, it's important to understand how ordinary income is taxed, how capital gains is taxed, and it does not necessarily impact one another. Now here's what capital gains does impact. It does impact your adjusted gross income. So your adjusted gross income is a combination of things like salaries, rents, it's a combination of capital gains, all the different income sources you have. That matters because your adjusted gross income determines things like eligibility for IRAs or Roth IRAs. It determines what your IRMA surcharges might be. It determines your ability to take certain deductions or exclusions or not take them. So there are other nuances that you do have to take into account with capital gains, and capital gains will push your adjusted gross income higher. But for example, if you're in a 24% bracket and you're on the edge of should I sell this stock or not sell this stock because I don't want to be pushed up into the 32% bracket, the good news is as long as those gains are long term, it's not going to push you into a higher bracket on the ordinary income side. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.